The bad news is that the Fed has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the economy, the U.S. economy, is in recession. And if you've tuned in before, you know that we believe that that Europe and China effectively have been in recession as well. So now a global recession.
As other investors worry the U.S. could face a recession next year, ARK Investment Management founder Cathie Wood thinks one already has hit, and it could be over next year. While many economists and strategists have been resisting the notion that we are in a recession and anticipate that the U.S. may enter one next year, we actually think we'll be coming out of it in 2023, said Wood, ARK's chief executive officer and chief investment officer, during the firm's monthly webcast Tuesday. We think we're in a pretty significant inventory recession, but we don't think it will be anything like the systemic recession and financial crisis in 2008, 2009, she said. It'll be more of a garden variety. From the mid-1940s to 2007, the average U.S. recession lasted 10 months, according to a 2008 study by the Federal Reserve Bank of San Francisco, with the shortest in that stretch lasting only 6 months. Wood said that innovation is recession-resistant, pointing to the recent shift back towards growth stocks as a sign of this trend, as their growth rates are superior to the rest of the market, which tends to be more influenced by the cycle. Growth stocks trounced value equities last month, with the Russell 1000 Growth RLG, plus 0.03% index surging 11.9%, while the Russell 1000 Value Index RLV, plus 0.26% gained 6.5%, according to FactSet data. Wood's flagship fund, the ARK Innovation ETF ARKK, minus 0.38% surged 13.2% in July, but it has suffered deep losses so far in 2022. The fund fell more than 5% Tuesday, bringing its plunge this year to around 49%, according to FactSet data. Major U.S. stock benchmarks are also down for the year. The technology-laden Nasdaq Composite Comp, minus 0.26%, has dropped around 20% this year through Tuesday, while the S&P 500 SPX, plus 0.30%, has tumbled 13.5%, and the Dow Jones Industrial Average DJIA, plus 0.46%, is down almost 10%. Investors are looking ahead to the next inflation reading, with the highly anticipated July data from the Consumer Price Index due out Wednesday morning. Investors will be looking closely at the data to help them assess the potential path of rate hikes by the Federal Reserve, as the central bank seeks to tame soaring inflation through tighter monetary policy. Read, U.S. consumers likely got some relief from sizzling price increases in July, but Fed won't feel any better. While the CPI data for July could be flat, or slightly up or slightly down, Wood is expecting inflation to ease in the coming months. She said that gold GC00, 0.03%, has been an excellent leading indicator of inflation in her career, with many people surprised to learn that the price of the yellow metal peaked in August 2020. Wood also pointed to the decline in copper HG00, 0.32%, and energy costs, including the recent drop in oil prices CL.1, 1.17%. And she suggested that blown-out inventories at companies should lead to lower prices in the next few months as businesses try to get rid of it. The Adobe Digital Price Index, which is focused on e-commerce, recently fell, another sign of the inventory overhang out there that companies are trying to cure right now, according to Wood. In her view, innovation, particularly if it's technologically enabled, is deflationary. But it's good deflation, she said. U.S. stocks ended lower Tuesday, with the Dow down 0.2%, the S&P 500 falling 0.4%, and the Nasdaq dropping 1.2%, according to FactSet data.
It was back then with the boom bust, so that's saying something. The S&P down 20% year to date, Nasdaq down roughly 30%. So the stock market has not seen a worse year to date since 1962. And that was when the Cuban Missile Crisis took place. And then what happened after that is we ended up in the Great Society, guns and butter, and inflation took off. But first, the stock market was a barn burner. It was very hot from 62 to 66. When it comes to bonds, this has been the worst year-to-date performance in bonds in anyone's lifetime. And by some measures, you have to piecemeal the bonds, but to try and get the record, the worst since 1788. That's more than 250 years ago. So, or almost 250 years ago. So it's been a very, very rough market for investors. We think there is light at the end of the tunnel. The light is that the Fed is getting a lot of signals that will ultimately end up in the lagging indicators called the PPI and the CPI. They're getting a lot of indicators, and I think a lot of companies are going to be telegraphing in their earnings reports this next month that we are in recession. Years of systemic collapse have been rife in the marketplace. So we've seen Bitcoin, it peaked way back in November at 69,000, and it is now at 19,500. It is still higher than its pre-COVID 7,000 to 10,000 range. And it is just about at its 2017 high. So this could be some support. It's also at it is below its 200-week moving average, which is at 22,500. So there is some concern that that is the new resistance. Now, as we've seen the last month play out, talk about a reach for yield. Crypto personified that. DeFi personified that. And we knew that the Luna Terra experiment with algorithmic stablecoins was not going to work. It was backed by nothing. And I remember we did a podcast with Do Kwon. It's still on our site. And I remember listening to it twice because I couldn't understand what he was doing or saying. I am an economist by background, and so I really do try and noodle through these things. And I just didn't think that was going to work. And it failed in spectacular fashion in May. And has taken Celsius down with it, Voyager Digital, 3 Arrows Capital, BlockFi almost. It was very interesting to see BlockFi's last funding round at $3 billion. This is a lending platform. And tried to do another round recently at $1 billion. He couldn't get it done. And today it seems that FTX is going to buy it out, or it has the option to buy the equity for $240 million. A rumor this week had it at $25 million, so much better than that, but much worse, less than a tenth of its last round. And it's not just happening in crypto. Klarna